If you are an investing nerd or want to learn how to put your money to work to create another income stream, this video is for you. In this video, we are going to learn the difference between cryptocurrency staking interest and stock dividends. So before starting, please like this video and subscribe to this channel for more content like this. First, what is cryptocurrency interest and how does it work? Some decentralized finance platforms allow owners of cryptocurrencies to generate additional income streams from their assets. As a result of the numerous advantages they present to account holders, crypto savings accounts are quickly becoming increasingly popular. The value of such DeFi applications increased from approximately $1 billion to around $4 billion between June 2020 and January 2021. Traditional savings accounts and cryptocurrency accounts that earn interest both function in the same way. Users make deposits of their cryptocurrency holdings into an account managed by either a centralized or decentralized savings platform. And in exchange, the platform awards the users with periodic interest payments. The biggest differences between a cryptocurrency savings account and a regular savings account are as follows. In contrast to fiat currencies, the value of cryptocurrencies continue to rise even while they are being lent out. The interest rates paid out by crypto savings accounts are significantly higher than those paid by conventional savings accounts. When compared to the interest rates offered by conventional savings accounts, the crypto savings platforms provide astronomical returns on investments. For instance, the cryptocurrency savings platform BlockFi offers its customers an interest rate ranging from 0.10% to 9.50%. Another online savings platform, Celsius, offers interest rates that range from 9% up to 17% in certain circumstances. On the other hand, the interest rates offered by conventional savings accounts typically range from 0.50% to as low as 0.06%, with the highest available rate being 0.50%. Decentralized finance platforms, in contrast to traditional financial institutions, are in a position to offer such exorbitant interest rates because they can make loans at high interest rates using the savings that their customers contribute. Conventional financial institutions can only provide interest rates tied to the prime rate. Investors who are concerned that the speculative nature of cryptocurrency prices would result in a loss of value over time for their holdings now have an alternate option available to them in the form of stablecoins. There is a subcategory of cryptocurrencies known as stablecoins. These cryptocurrencies have their value pegged to another asset, most frequently the US dollar. As a result, investors' funds are protected from price fluctuations, creating a haven of stability within otherwise volatile cryptocurrency markets. BUSD, DAI, Tether, and USDC are just some stable cryptocurrencies that are widespread adoption. Now let's take a look at the dividends and how it works. The gains that accrue to a firm throughout a given period are used to fund what is known as dividends, which are periodic payments distributed to the company's owners. Stockholders receive a return on their investments in the form of dividends. It is possible to make payments on it on a monthly, quarterly, semi-annual, or annual basis. Investors receive dividends for each share that they own in the company. For example, if the company pays 10 cents per share and an investor has 10,000 shares, the investor will receive a total of $1,000 in dividends for that period. Dividends payouts come in different forms. First, some dividends come in the form of cash. Cash is the most popular form of dividend payouts. Companies that pay this kind of dividend typically deposit money into shareholders' brokerage accounts in the form of cash. Other dividend payouts come in the form of stock. Companies that wish to keep earnings but yet reward stockholders at the same time find paying stock in dividends to the investors find it more appealing than paying in the form of cash. The best way to grow your stock portfolio is to turn on reinvestment programs known as DRIP. When a company uses this strategy, investors can use the dividends they receive to buy more stock at a lower price. Next, special dividends. Companies that have collected money over the years that they are not using typically use this strategy. The general distribution of shares receives this erratic dividend. Last but not least, preferred dividends. This dividend is usually paid every 3 months and is always the same amount. It is mostly for people who own preferred stock. Crypto interest pros and cons. Pros of earning interest in cryptocurrency: higher interest rates. Savings account owners will make more money from cryptocurrency investments than from conventional savings accounts. Low or no minimum lockup time. Compared to traditional finance, stored cryptocurrency funds are significantly more straightforward to obtain in an emergency because DeFi savings platforms typically offer minimal or no lockup periods, unless they are staked for a period of time. Another pro of earning crypto interest is the potential for interest growth. The interest value obtained from a cryptocurrency savings account will proportionately increase in value, along with the underlying crypto assets increase in value. For instance, let's say that investor X saves $10,000 worth of cryptocurrencies at an annual interest rate of 8%. The investor should earn $800. But if the value of the cryptocurrency increases to $20,000, the investor will receive an interest payment of $1,600. No minimum amount. In contrast to traditional financial institutions, users of crypto's staking platforms are allowed to begin their savings with any available amount, which typically requires a certain amount to be saved before they can start staking for interests. Cons of earning interest in cryptocurrency market. Floating interest rates. The value of interest payments is subject to market dynamics such as demand and supply, despite interest rates typically being relatively high. This means that if the value of the underlying cryptocurrency asset goes down, the value of interest payments may also go down. No regulation. Investors are at significant risk of falling victim to frauds that pose as legal savings platforms because of the absence of regulation and control of decentralized finance platforms. No insurance. Any federal deposit insurance institution does not cover the majority of digital financial innovation, DeFi, savings platforms at the moment, but it might change in the future. This means that investors have no protection if the DeFi platform goes out of business. Risk of borrower default. The possibility that borrowers cannot repay their debts is a concern for all loan providers, including saving and lending platforms like DeFi. Suppose the platform does not have any preventative safeguards in place. In that case, there is a significant possibility that the value of the crypto assets that were used as collateral to secure the loan might plummet overnight. This would make it extremely difficult, if not impossible, to make a recovery. Dividend pros and cons. Pros of dividend investing: safety from volatility. Both the stock and cryptocurrency markets are very unpredictable and volatile, which both markets have in common. Investors interested in the stock market but still desire a high level of safety may find dividends-paying stocks an exciting investment option. Instead of betting on the ups and downs of the market, investors can buy the stock of stable, well-known companies and get regular dividend payments. Passive income stream. For investors, dividends are a stable source of passive income that they can count on receiving. Once the investor gets dividends, he can use that money to buy whatever he wants. Dividends offset inflation. The value of dividend payments tends to go up over time, which helps investors deal with the effects of rising inflation rates on the economy. Cons of dividend investing. Lower long-term returns. Regardless of how frequently the value of dividend payments continues to increase, there will come a time when it will level off. There is no denying the importance of the peace of mind that dividends offer, but there are other investment strategies that provide the potential for far better returns over the long term. Management goals may not align with the investor's goals. The distribution of dividends depends on the company's management continuing to support the practice of paying dividends. However, if the company's economy struggles, it might decrease the dividend payments or terminate the dividend in some cases. This development would throw off a passive investor's approach. It is highly recommended to invest in EFTs because they are less risky than individual stocks. Double taxation. In contrast to other investment techniques, a plan for producing passive income based on dividend investing would result in the dividend being taxed by the government not once, but twice. The company has to pay the first tax based on its income, and the investor has to pay the second tax, is based on the dividends they receive. Dividends are still highly susceptible to market movements. Although passive investors prefer dividend investment because of the increased security it provides compared to swing or day trade, passive investors' dividends are still subject to fluctuations in the market. When investors bet against a company, its stock price may drop quickly. This may cause the company's leaders to change their minds about how to spend their money, which could lead to a cut in dividends. To conclude this video, I would like to add that investing in cryptocurrency interest and dividends are both tactics that will attract the attention of various investors. People who invest in crypto interest accounts are willing to take on high risk, but with a high reward if their investments go their way. On the other hand, dividend investing appeals to those who want to get into low-risk stocks with a small reward compared to cryptocurrency rewards. So the last question comes down to you. Do you prefer staking and owning crypto interest or investing in a dividend-paying stock? Let us know in the comments below. If you enjoyed this video and want to learn more about cryptocurrency and the stock market, please subscribe and turn on the notification bell so you can get notified every time we post a new video. As always, have a wonderful day, and I will see you in the next video.